Broadcasting from Baltimore, Maryland, and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here is your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Okay, our interview this week is really good. It's with a really smart, really successful investor named Harris Kupperman. Get ready to take some notes because he's going to discuss his two of his highest conviction ideas right now, and you'll want to hear what he has to say about them. I know you're really going to like hearing about that. But before we get to that, I do have a few thoughts to share. And my first thought to share is about Tesla, because I haven't talked about it in a while. And I don't know if you noticed, but the stock hit $500 on Monday. You remember, I think the last time I talked about Tesla, I was saying, I agree with my friend Whitney Tilson, man. He says that thing is going below $100 this year. And that was months ago. That was last year. And of course, it went below 200 and turned around and started rising, and now it's 500. And he's written about this. He's acknowledged it. And in December, he was like, whoa, don't short this thing now because, it's ripping and it's in danger of melting up. And he's been right about that so far. So it's got a market cap. Tesla has a market cap of like over 90 billion. I think it's around 93 or 94 billion now. More than Ford and GM combined. One report that I saw said it's the highest market cap ever achieved in history by any American car company. Meanwhile, another report I just saw said Tesla sold 19,000 cars last week and the American automakers sold more than 600,000. So, look, the problem with Tesla right now is not that it's guaranteed to go to zero or that it's a fraud or anything like that. It's that the stock market is now saying Tesla is more valuable than Ford and GM combined, meaning the stock market says it'll produce more excess cash profits over the long term than those two companies combined. And you know what? That could even be true. But don't you think it's a little presumptuous of the stock market to treat it like it's guaranteed to happen with, producing less than 20,000 cars in a week when the other two are making like 600,000? It's gotten way, way ahead of itself. Even if everything turns out perfectly, it's still way, way ahead of itself. And of course, this is what we mean when we say Tesla is drastically overvalued. You don't have to claim that Tesla is a zero or that it's a fraud or anything like that. All you have to do is know what the current valuation means when you compare it to the U.S. automakers like I just did. On that basis alone, there's no way a good, smart investor can own this thing right now. I'm sorry. You can say, well, you've been wrong all day long. Okay. You're right, but you have to explain to me how this thing is worth this much. And the only way you can do that is by looking out into the future and saying, many wonderful things are virtually guaranteed to come true. And they better come true because you're paying for all of them right now, right? So the stock has doubled in the last 3 months. And another company I noticed is up, like General Electric is up like 40% during that time. Tesla and GE, you know what they are? They're the two most valuable money-losing public companies right now. According to a Wall Street Journal piece, the percentage of listed companies losing money over the last 12 months is nearly 40% right now. 40% of all the listed companies lost money over the last 12 months. The highest non-recession level since basically the dot-com boom. Late 1990s. And it's even worse for IPOs. So the proportion, the percentage of money-losing IPOs hit 81% last year. The same level it hit in 2000 at the peak of the dot-com bubble. And, I realize people are listening to me right now and they're going to say, money-losing IPOs? You mean 19% of all the IPOs actually made money? Where are these companies that are making money? Where are these IPOs that are making money? Because you never hear about them. They don't make the news because they're not sexy and exciting and going to change the world, I guess. They're just like little banks and things, But to me, this looks like an accumulation of misallocated capital. That's just my gut reaction. Maybe somebody who has studied this phenomenon and has all the statistics and disagrees, but that's what it looks like to me. It's typical of big bull markets that after they get going for a while, people become more tolerant of risky situations. And certainly investing in a money-losing company with no history at all, right, an IPO, is pretty risky. And there are more of those around now than at any time since the dot-com peak. So, be careful. At the opposite end of the spectrum, of course, are value stocks. Here he goes again. On value stocks. So Research Affiliates is a research firm co-founded by Rob Arnott, one of the smarter financial analysts of the last few decades. Research Affiliates came out with two different reports in the past couple of months showing one of them says, quote, the current underperformance of value stocks relative to growth stocks has exceeded most and in emerging markets all previous drawdowns. And yes, the appeal of stocks like Tesla is that they'll grow so much. That's what's being discounted in the price. So overall, though, Research Affiliates found that value is the superior long-term bet. I mean, it's the ugly bet right now, but it's long-term. It does better. They said, quote, historically, value stocks around the globe tend to win more often than they lose, beating growth over 5-year rolling intervals, approximately 55% of the time, rising to 70% over rolling 10-year intervals. Those quotes are from a paper titled, Standing Alone Against the Crowd, Abandon Value Now? And that was published in November. Another paper by the same firm, Research Affiliates, was published just within the last several days here. It's just dated January 2020. It doesn't have a specific date. It's called Reports of Value's Death May Be Greatly Exaggerated. This one makes 2 points that I found pretty interesting. It made several points, and it's fairly technical, but the two things I found interesting, first, is that value, as I've said many times, including right now, value has become drastically cheaper than growth, right? The slower growing, but still mostly profitable businesses have become cheaper than the much faster growing and some unprofitable businesses today. But the paper notes both growth and value are expensive relative to past norms. So I've pointed out many times that, like I said, value stocks are cheaper than growth. But if you look at basically any value ETF, you'll probably see something that's up like 200% in the last several years. And the growth ETFs are up 300%, right? So there's the outperformance, but it doesn't mean that the value stocks haven't risen. The earnings haven't risen that much, so the stocks are more expensive in both cases, right? So the RA paper is just pointing out that they've both gotten more expensive versus historical valuations. I don't want to make it seem like, value is the dirt cheapest thing in the world right now. Although there are some little pockets here and there, but you have to find them. Okay, so that's the first thing, is that they've both risen. Value and growth have both risen over the past several years. It's just a relative assessment. And the second thing is, and this is a quote from that second paper, since 2007, well over 100% of the shortfall of value relative to growth is due to value becoming relatively cheaper. In the most recent 12-year period, the revaluation component appears to be the key to understanding why growth stocks outperform value stocks, end quote. So he's describing what I talked about with Tesla a moment ago. Remember, I said the market is discounting that Tesla will generate more cash profits over the long term than Ford and GM combined, even though it has no track record of consistent profitability, and both Ford and GM do. If Tesla just fails to perform spectacularly in terms of revenue and profit growth, you'll probably lose money paying these prices, no matter how high it goes in the meantime. So even if it hits 1,000 tomorrow, you'll probably lose money on it unless it performs spectacularly well over the very long term. In terms of the business performance, right? The revenue and the profits. You remember those, right? It's more than just the share price. That's just common sense and basic arithmetic, right? And what did the RA paper I quoted just now say? It said revaluation was the biggest component in underperformance of value versus growth over the last 12 years. In other words, investors right now, they just very much want to pay up today for growth in these exciting companies that they see in the future. They see them growing fast right now. They see them growing fast in the recent past. They're excited about the technology, and they just pay up. They're getting all excited about it because they think they're going to make a ton of money, a ton more, okay, than they've already made. And by contrast, they're unwilling to pay up for profits earned today in less exciting, slower growing, but still profitable businesses, right? The value stocks. And I think of growth stocks like negative yielding bonds, actually, right? The bonds become negative yielding. They're guaranteed losers because they cost more than the principal and all the interest payments, right? So the price you pay is more than all you're guaranteed to get back out of it. Well, just substitute earnings and earnings growth for interest payments, and that's what stocks like Tesla and even some profitable companies look like to me today. So we're in this period now, I think, kind of officially, if you will, of unbridled optimism. It's kind of fun because I think we can probably all get excited about new technologies to some degree. I still think having an iPhone means I'm cool. And I look at this thing every now and then and I think, wow, this little phone, it's way more powerful than desktop computers and those giant early computers that took up a whole room. Not in fairly recent history. It's pretty exciting, right? But as an investor, you have to get other things right. Not just which technology will be more widely adopted in 5 or 10 years or whatever. You have to not pay so much for the earnings of a company that you're still going to lose, even though the company may succeed, right? It's just like that negative yielding bond. Those people are going to get all their interest payments. They're going to get paid back their principal. They just paid so much for it that they're guaranteed to lose. Same thing. Ask anybody who bought Cisco in March of 2000 and is still holding it today. Right? They're still showing a loss. 20 years later, they're still showing a loss. And this difference in investors, well, almost 20 years, okay? I'm 2 months ahead of myself here. But you get the point. And this difference in investors' excitement and optimism really for some stocks versus others, it's a different effect than if there were a big difference in profitability between the growth and value. You understand what I'm saying? They're just paying more because they like them better for, you could say, irrational reasons, rather than being kind of strictly rational and saying, well, this is a better bet relative to the price and the value, so, I should be buying this other cheaper thing. Nope, that's all out the window now. So in other words, if I read this RA paper correctly, Research Affiliates paper, they're saying that the difference in performance between growth and value stocks the last 12 years, it's not because value companies are less profitable. They weren't. At least not enough to explain the huge underperformance. So what you're looking at today is, I would say, pretty typical investor behavior late in a bull market. They're all excited about the money they've made. Whee! Or maybe they're jealous of the money their friends have made and they want to get in on it. Now, there's a little side issue here, right? When I say investors, I don't necessarily mean individuals like you and me. By now, it's pretty widely reported that institutions move markets today, not the mom and pops day trading like back in the dot-com era. But to me, that doesn't mean anything. Institutions are just groups of people. And if individuals behave poorly near market tops, groups of people behave like suicidal maniacs high on speed. I mean, I would say groups of people in such situations behave worse than individuals because they're in this hive of peer pressure all around them. And they're always, gauging their performance relative to some index or other. And man, when the index starts doing poorly, they all start selling too. So when the bull market cracks this time around, whenever that is, I think the bear market is going to be so bad, and who knows, maybe so long, but not necessarily, but so bad that people will start to wonder if the stock market isn't permanently broken. And you could say, I know that somebody just started typing a question, Dan, isn't it permanently broken today because stocks are so overvalued? Well, yeah, but nobody's going to say that. The people who say that are people like me who've been wrong for 3 years, okay? So they won't start saying that until a whole bunch of people look at their 401ks and go, oh, God, now I'm going to call it a 101k. Remember, they called them 201ks back in 2009. So, look, that's all I have to say about that. Stocks, a bunch of stocks have ripped. I mean, I just looked at a bunch of charts and like Uber and maybe Peloton and a couple others. But I just looked at a bunch of money losers that have done, Beyond Meat, that was the one. It's ripped. I mean, it's just ripped. It was like 70 something. Now it's 120 something. And who knows why? Maybe there's a short covering. I don't know. But it sure seems like people are falling back in love with these money losers. Not all of them. But a few of them. That they're just, super excited. People are still excited about meat substitutes. There's a lot of commercials on TV. There's a Hooters commercial now where all these Hooters girls, in their basic, that outfit is like underwear. So these girls come on the screen in their underwear eating like chicken wings or chicken nuggets or something. And it's like fake meat, it's plant-based stuff. So that idea is still exciting. So who cares if it's losing money hand over fist? It's exciting. And so let's just get back into it and buy, right? Because Tesla was way the heck down and it turned around and took off like a rocket. And so maybe Beyond Meat is doing that now too. Who knows? But we know that it's got nothing whatsoever to do with profitability, right? That was the theme I just kind of weaved through my ranting and raving today. Let's do one more little tidbit before we talk with Harris Kupperman. I found a couple of neat little surveys. Look, I don't vouch for the statistical method on these things, but I find them and they're interesting. One of them's in The Economist. That should be pretty good, right? They published a list of 28 countries based on how many books were published per 1 million of population. And this is as of 2016, okay? So it's a few years old. So can you guess the number one country? The number one country that has published the most books per 1 million of population. What do you think that would be? Turns out it's Japan, with more than 10,000 titles per 1 million population published in 2016. Number 2 is China, and number 3 is South Korea, both right around 7,500 books per 1 million. Numbers 4 through 17, all European countries. Number 4 is Denmark with about 4,000 books per million. And I said number 4 through 17 were European countries. Number 18, you guessed this one? Yeah, the United States, 1,000 titles. So Japan publishes 10 times as many books per 1 million population as we do. And the list went to number 28. There were 28 of them. Almost all the rest were European countries, 2 Latin American countries, Argentina number 23 and Colombia number 27. So what does all this mean? That Asian and European countries publish more books per million of population than the United States. Technically speaking, I'm guessing, or maybe it doesn't mean anything, but I can't help thinking of those studies that we hear of. Every couple of years in the news, you hear a study that Asian and European countries are scoring a lot higher on math tests. They do a lot better on math than the United States. And this sure makes it seem like, they're reading a lot more books. And in fact, there was another study that I want to just talk about real quick. And this one was which countries actually read the most as opposed to publish the most. And it looks very similar, except the number one country, they were doing hours per week of reading per person. And the number one country was India with 10 hours per week. Then Thailand, China, Philippines, Egypt, Czech Republic, Sweden, France, Hungary, Saudi Arabia, Hong Kong, Poland, Venezuela, South Africa, Australia, Indonesia. The United States is number 22, cutting to the chase. And there's all these other countries in between. So that was more varied than the publishing list, because we had, Saudi Arabia, Egypt, Hong Kong. Well, Hong Kong's an Asian country. South Africa is in there, Australia. So a little different, but the point is, it ain't the United States up high on the list, on either list. And my point is, I don't even care. I don't care what they're reading. I don't care if they're reading just a bunch of romance novels or whatever, because I just feel like reading is a superior way to take things in. It's more active. You have to reach out with your mind and grab a hold of it and comprehend it. Whereas when you're watching television or looking at some video on the internet or something, you're passive. You're just sitting there and it's kind of washing over you. And people say, I always chuckle a little bit when people say, I only watch educational programs on TV. I watch National Geographic. And I watch those too, but it's entertainment. It really is. It's passive. It's entertainment. It's not learning. It's not actively studying and grasping and learning something valuable. So it looks to me like a whole bunch of other countries are filled with people who are spending more time actively learning and reaching out and grasping things. And in the United States, we are, trying to impeach a president who doesn't appear to have done anything impeachable. And we are worried about what bathrooms people are using and all kinds of other stupid stuff. And, we're obsessed with, I don't know. It strikes me just the way we think about things in the year 2020. We're all worried about gender and race. We're hyper obsessed with gender and race. We seem to be anyway. I realize that this is just what, the news represents, and we all live our lives a little differently than what they represent. But still, it's on people's minds. And, out west, you get into a conversation at a party or something, and people jump right down your throat on this stuff. But the obsession with race and with gender and all this, you know what it reminds me of? It reminds me of these TV shows that my wife watches and that I watch with her sometimes about these people who volunteer to go to jail. And in jail, everything is based on, the white guy and the black guy and the Latin guy and the white girl. And they're split up by gender, of course. The girls are in a different jail than the guys. And I just feel like our whole society feels, it's like we all think we're in prison and we're afraid of getting shanked, so we got to be careful about who we talk to and who we offend. It's weird. And I don't know. I think we're obsessed with the wrong stuff. I think we should read more. We should publish more books. We should be more like India and China and Japan and these other countries and publish more books and, learn more valuable stuff. Anyway, you get the point. Maybe I'm wrong. Write into feedback@investorhour.com and tell me I'm wrong. But okay, let's do away with that. Let's finish up with that. And let's just talk with Harris Kupperman right now. This is going to be interesting. I promise you. Our guest is Harris Kupperman, and Harris Kupperman is the founder of Praetorian Capital, a hedge fund focused on using micro trends to guide stock selection. Harris is also the chief adventurer at adventuresincapitalism.com, a website that details his investments and travels. Additionally, Harris is the chairman and CEO of publicly traded Mongolia Growth Group. Please welcome, ladies and gentlemen, Mr. Harris Kupperman. Harris, welcome to the show.
Hey, thanks, Dan. Happy to be on.
So the first thing I ask almost everybody who, especially the folks in your profession, is how old were you when you knew that you were going to be a professional investor?
That's a good question, actually. I started trading stocks. I was in boarding school at Phillips Andover, and I started trading stocks my senior year instead of going to class. And I almost failed out of class, but I wasn't really making any money at it. It was really, I guess, a year or two later when I started actually making decent money at the investing side that I realized that was the future for me. I remember actually I had this, my father's doctor, and I came to him my sophomore year of college and said, I think I should drop out of school and focus on this full time. And he told me, why would you do something stupid like that? And I said, well, I'm making more money than you, and you did 15 years of college. Like, it kind of makes sense, right? And
Yeah, that makes a lot of sense.
yeah, I was in my fraternity house, and all my friends were, doing odd jobs or selling weed to each other, and I was just trading stocks, and I was making more than all of them combined. It just seemed obvious.
Well, that's a hell of a comeback for your kid to say something like that. What'd your father say?
Oh, he said, "My mom's gonna kill me if I drop out. I gotta finish." But he 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 let me do night school instead, because I mean the markets are open during the day. So I basically invested in during the day, and then at night I went to night school, and he let me take whatever career path I wanted in terms of a degree. So I became a history major because I found it interesting.
That's a pretty good story. So your father had no comeback because you're making more money than he is. So he puts it off on your mom and says she's really going to be pissed off.
Yeah, yeah. He said
That's
she's gonna kill
classic
me.
dad stuff.
Yeah, pretty much. So I finished my degree. I got a bunch of B's and C's, but I made it through to the end. And yeah, now I have a degree in college, for whatever that's worth.
Yeah. That's a pretty good story as they go. Some people are just like, well, I didn't know what I want to do after college, and I got a job as an analyst. But that one's pretty good. So I've been all over your website, and there's a comment like I know you've done other things that we'll talk about, but there's a comment that it just like stuck in my mind. And I hope you don't mind if we just get straight to that because
Yeah, sure.
um, it said, equities are all risk. The sentence jumped off the page at me. I was like, equities are all risk. Nobody comes out and tells you that. I think I know what you mean by it, but tell us what you mean by it. I think this is really valuable for the listener to hear this.
Well, I don't remember exactly what the context was, but I've said that before. But equities, you can have a company, it's $1 billion company, it can go poof the next day. You never really know what's under the hood there because management teams lie, you can have fraud, you have scandals, pretty much anything that can happen. You have governments that can just change the rules on you. When you own an equity, you don't really own anything. You own kind of the collective hopes and dreams of other people that own shares. It's not like owning something that's real, like a gold coin or something.
It's funny because there are a lot of value investors out there who will say the exact opposite of what you just said. They'll say, you own a piece of a business with this. It's not like owning something crazy and worthless like a gold coin, which I find
Well,
very interesting,
well,
right? I mean, it's true.
yeah, look, you own a piece of a business and you have to think of it that way. Like, I don't think of these things as stock charts or ticker symbols. I think of owning part of a business because oftentimes I'm going to be there for, more than a month. I'm probably going to be there for a few quarters to a few years. And so, you got to treat it like a business. It's a living, breathing thing. But, I've done this for 20 years now, and I've seen companies that I thought were just phenomenal companies disappear very fast. And I've seen companies that I thought were about to disappear become great companies. It's very kind of ephemeral, and you have to treat it as such.
Right. And actually, let me put that comment in context. You have a piece that you posted in March 2010 called What Does Cheap Really Mean? And that sentence was, remember, equities are all risk. And then you said, don't take on that risk unless you have the chance of earning enough to make it worthwhile. And then I think later on you said, you want things that can turn into a multi-bagger and with, relatively limited downside, that asymmetry that you're always talking about. So that was the context of that.
Okay, yeah, that helps a bit, and I think that actually is a very good point, and that's the bigger point I'd make, even than the equities are all risk side, is that too often I see guys come into an equity and they say, this thing's trading at 10, I think it's worth 13, and if you wait long enough, just normal market volatility probably gets you your 13 eventually. But you might get a 0 along the way. And if you're going to take the risk of buying something that really could go to 0, and all equities can go to 0, you really have to be guaranteed that you're going to make a few times your money if you get it right. I always look at the downside of every position I own, and I want to know that there's balance sheet strength and the debt's termed out and all this other stuff that people care about to the downside. But really, the way you protect your portfolio is the few winners each year that you have. If you have a company that goes up 2, 3, 4 times and it's a big piece of your book, you could have mistakes and it just won't really matter. And it's those winners that actually hedge your portfolio in a way. And this year's a perfect example of that for me. And I feel like not enough people look for the upside. They kind of say this thing has 20, 30% upside. And to me, that doesn't even go into the interesting category. I need stuff that could, at least double in the next year and preferably 3 to 5 bagger in the next 3 years.
In equities, 20 or 30% is noise, right?
Exactly. It's just noise. And I see too many people get stuck in that trap of looking at noise and missing the bigger picture, which is how do you find something that's going to go up 5 times?
Yeah, I'm looking for those things too. I don't always find them, but I think we found a couple of them that have kind of limited downside. And you mentioned, I think it was in some other place on your website, you mentioned looking out. You said something like, look out 5 years. Everybody has an idea about what the earnings are going to be over the next year and maybe even the year after that. But nobody's really looking out 5 years to see if this thing can really grow enough to make you that multi-bagger return, which I thought was a great point, because you're right. That's what everybody's doing. Everybody's saying, what's going to happen on the next earnings call or what's going to happen next quarter. It just,
Right.
It all seems a little silly.
Well, I think a lot of the guys listening to this podcast are the type of people who manage their own money personally. If you're going to be running a mutual fund or a hedge fund, you have to be thinking about what happens tomorrow, because your performance is, driving your marketing, which is then driving your inflows and outflows. So all you care about is next month and next earnings release. But if you're a guy sitting at home and trying to make good returns for himself, next quarter, who knows? Like, I have friends, they're doing all sorts of option trades and they're analyzing these things and they're sitting there at these analyst conferences trying to read the body language of the CFO to figure out if they beat or miss by a penny. It's kind of stupid, because there's a lot. One, it's really hard to do. Even if you told me a company would beat or miss, I don't know if the stock's going to go up or down. Two, you have a lot of people positioned that are really, really smart doing this. And, when you think where these guys don't have any edge, they have no edge out a year or two, because if they're wrong next quarter, they have no capital in 2 years. So they can't even think out that long. That's where the opportunities are for guys like me, and I run a fund, but I think out a few years. But guys sitting at home with their own personal accounts, you got to think out a few years. The stuff that's near term, next couple of weeks, next couple of months, that's pretty well hedged out and arbed out. You have to look out further, where guys aren't playing.
Yeah, and for our listener, this is like classic value investor thinking, right? It's time arbitrage. Everything that's in the stock is in it, is what people think over the next year or two. Nobody is looking out farther than that. And you're right, people are mostly looking out, like the people I talk to, they're looking out next week. You know what I'm saying?
Yeah,
They're looking at charts and like you say, reading body language and doing all kinds of crazy things like looking out next week. So like looking out 5 years, if you have the discipline to really do that, it over time, it has to be, or at least contribute mightily to a real competitive advantage if you're any kind of a decent analyst, right?
Well, absolutely. And as time frames keep compressing, you don't even have to look out 5 years. You can look out a year or two. And, especially in the sort of companies I focus on, which are companies that are at some sort of inflection, you don't have to know exactly when it inflects. You just have to know that an inflection is coming. And you have to be positioned where a lot of other guys are saying that's dead money for 6 more months. And then they're going to miss it because, the stock starts trading up in 3 months.
You have an example of what you just described. You have a position in Altisource Portfolio Solutions. Isn't that... You're waiting, aren't you waiting for that to inflect? And you're still waiting, right?
Yeah, I'm still waiting. It's one of my largest positions. I think I'm buying a SaaS company at 3 times earnings. You basically have three businesses there. One is shrinking
Hmm.
quite rapidly. Two are growing quite rapidly. And so people look at this and they say this is a asset light service provider with a very heavy software component, which is great business, but it's shrinking. But what's going to happen, I believe, sometime in 2020, probably Q2, maybe it's Q3 or Q4, is that the growing piece of the business is going to catch up in terms of the growth rate to the piece that's declining. Think of it as two curves. One's going down, one's going up, and they're going to cross eventually. And when they cross, this stops being a shrinking company, it becomes a growing company, even though there is a component that's still shrinking. And suddenly you get a growth multiple. So it stops being 3 times earnings and it goes to, let's call it 20 times earnings. And so, you can look
Hmm.
at this and say, we're probably going to make, 5 to 7 times our money when the market revalues it. It'd probably take a few quarters of growth to get revalued. And you have a free lottery ticket look at the fact that it's a play on housing defaults picking up. If you're bearish on the economy, which I am, and you think defaults pick up in housing and mortgages, then these guys could potentially make many times their current earnings, which gets you 30 or 50 times upside. If you look at what happened in 2009, the last housing cycle, this stock appreciated 30 times, 30 times, which is one of those life-changing sort of things, whether you're running your own money or a fund like I am. And better, it hedges all your long positions because in an economic crisis, your longs will probably go down, but your alta source is going to more than make up for it, and that's that asymmetry I'm talking about. And while I wait, the company's going to keep buying back a few percent of the company each quarter. They've been about 2 to 4% of the company each quarter for the past few years.
So, what is it about this business that is going to thrive in an economically bad environment? What do they do that is going to be done a lot more when things are bad?
So they do, it's called a default mortgage servicer, but what they mainly do is property preservation. So think of it when you default on your mortgage. At some point, the person who owns the mortgage has to start taking steps to preserve the value of the property. So there's a whole conveyor belt, if you think of it, but it starts with them calling the owner up, hey, you're going to pay the mortgage. Then, they call again. Then there's a nasty letter. Then they start evictions. And at that point, these guys step in because you have a property that still needs to be maintained in service. So they're going to do property inspections. They're going to make sure that there's no squatters. They're going to maintain the property in terms of mowing the lawn, fixing the roof, protecting the pool, staging it for sale. All of that's a not very high margin business, but when you have a huge route density, it's a very profitable business. And it's the reason that there's very few of these companies in the United States, and AltaSource is probably the second largest. But that business grows dramatically as mortgages start going delinquent. Then you have another business, which is called Hubzu, where companies that own mortgages, mortgage servicers, start liquidating the properties. So it's kind of like eBay, but it's eBay for defaulted property. Their only competitor is auction.com. It's basically a United States duopoly. And this is really the profitable side. If you think of it as a conveyor belt, it starts with them maintaining the property and preserving the property, and it ends with them getting the opportunity to have an auction and sale of the property. And that auction of sale is very, very lucrative. That's 2 years after the property is defaulted. But as the number of sales of defaulted property increase, AltaSource's earnings will increase quite dramatically. If you look at the company, they're going to do about 100 million this year of cash flow in 2020, and that's adjusted cash flow because there's some one-timey stuff. But if you look at it, what happened in 2000, say 12, 13, 14, they did about 400 million. So if you think these guys can cover half of that gap maybe, and they get to call it 250 million, and you put a 20 multiple on it, you have a company worth $5 billion. And today we're sitting here at 300 million. And once again, this is that sort of asymmetry I'm looking at where I don't see much downside because of the valuation of the company, but I can see a whole lot of upside.
Wow, that sounds really compelling as you describe it. That's really cool.
Let's hope it works.
Another place, yeah, that's fingers crossed. One place where you and I are very much on the same page is in shipping stocks, especially kind of like from right now onward, I would say. And you own like a basket of them, do you not?
You want to talk about some shipping?
Yeah, let's talk about shipping because I think this is something that I want people to hear about right now. I think right now is a really interesting moment for this idea.
Yes, absolutely. Just some background. I've been following the shipping sector for almost my entire career. One of my earliest wins ever was a company called Frontline. It still exists. And I remember buying this in maybe 2002, 2003. I don't remember the exact date, but I just remember that about a year and a half after I purchased the shares, my quarterly dividend was more than the price I paid for the shares. And I made about 50 times my money, 50. And after you have something like that happen to you, you never forget about it. It was another company called OMI. I think it was a 15 bagger in 18 months. The thing about shipping that you need to remember is that it's a terrible industry. It's one of the worst industries ever created. It's net destructive of capital. But once every decade or two, there's a positive cycle. And on the up cycle, you get to make between 10 and 50 times your money. There hasn't been an up cycle where you didn't get these multi baggers. And that's because you have all the operating leverage of operating a ship and also the financial leverage on top of that operating leverage. And it leads to huge returns. We're looking at a lot of companies today where we think it's trading for less than their cash flow next year. And you have very good visibility on the cash flow because they're booking charters in January that don't finalize until middle of Q2. And you can look at the freight forward market and see that Q3 and 4 look quite robust as well. I think of shipping really as a supply and demand situation, which is what makes it so great to analyze. You're really just looking at what is the supply of vessels, what is the demand for vessels in terms of ton miles, and you're looking for mismatches. And right now, there's a large mismatch in tankers. What's really happening is if you look at trade flows across the world, you're seeing more and more oil coming from further away. And what I mean by that is that most of the growth is coming from Asia and India. And most of the growth in demand and most of the growth in supply is coming from the U.S. Gulf. It's coming from Brazil. It's coming from Guyana and West Africa. So the new supply is coming from further away, which means that to move the same barrel, you need 1.5 or 2 times the number of ton miles. That's the miles that the cargo has to go, which basically means you need more vessels to move this cargo. At the same time, you've had very low ordering just because big picture in 2000 and starting in about 2007 and 8, a lot of vessels were ordered because you had excess profits. These vessels were delivered 2010, 11, 12, and they just wrecked the market. And guys kept ordering. I don't know why they kept ordering, but they did. It was partly a function of QE, and it was partly a function of a lot of these shipyards that were built in China just going out and saying, hey, guys, look, we want to keep these jobs. We'll build a vessel. We'll finance a vessel. Just give us the order. So you had a bunch of guys literally saying, oh, cool, 0% financing or 1% financing. We'll just order 5 and see what happens. No money down. Let's just do it. And the end result is that you had this glut that's really bankrupted the entire sector for the past decade. You could look at a lot of these charts; they're all down 99%. A lot of them didn't even make it to the other side. And when you have a sector that goes bankrupt, they finally stopped ordering. You had a lot of scrapping in the last 2 years. And then finally, you have something called IMO 2020. And for listeners, IMO 2020 says that starting January 1st of this year, 2020, all fuel needs to be below 0.5% sulfur content unless you install a scrubber. So what that's done is it's made low sulfur fuel a lot more expensive. It's $300 to $400 a ton more expensive than the low sulfur fuel. Sorry, than the high sulfur fuel. The low sulfur fuel is much more expensive, which makes it much more expensive to operate a vessel. Which means that older vessels that are less fuel efficient are getting scrapped. Younger vessels are mostly getting scrubbers, which gives huge economic advantages. So it's going to lead to more scrapping, and it's just going to lead to more disruption. And disruption is good for shipping. And then, finally, Trump must be long a basket of shipping stocks because shipping is a play on geopolitical instability. And, pretty much every night he tweets something and my shipping stocks go up.
Harris, you made an interesting comment early in that explanation that reminded me of something Warren Buffett used to say about airlines. You said the shipping industry is net destructive of capital.
Yeah.
It makes you wonder why it's still around.
Well, it's needed. And the thing is that people keep investing in it because the upcycle is just so good. The idea that you could have a a VLC that you're funding it with a few million of equity, and it's making you a few million US a week in profits. I mean, you're having 100% returns on equity on a weekly basis. That it's the sort of thing that investors just dream of. And yes, it might only be an 18-month window, but you can make so much money that it doesn't really matter. And that's why people keep coming in. It's like gambling in a lot of ways. People know they're probably going to lose money, but there's always a winner every few years. Well, I mean, you have a jackpot winner almost every week in Vegas. That's what makes people keep coming back. And that's the same with shipping. The really good thing about being an equity owner is you don't have to buy vessels and sit there and lose a few $1,000s a day every day, 365 a year times how many vessels you have. You can just sit and wait for the great setups. And, right now it's in tankers. 2 years ago it was in LNG. Before that it was in bulkers. You can watch this sector and see where the setups are and really do quite well. And I think shipping is one of the greatest sectors for investors, especially guys like me that are looking to capture inflections and have multi-baggers.
Yeah, I feel similarly about mining. Different industry, but it's got some of the same dynamics and some of the same ability to get, huge multi-baggers out of, tiny little names that you'd never want to own most of the time. But sometimes you can find that, that moment and that limited downside and the cycle picks up and woo, you got a multi-bagger in a couple of years. And you're right. It makes your life as an investor, which you sort of alluded to this earlier when you were talking about, a single year, you get a couple, triple digit winners, and it doesn't matter if you lost on some other ones. I think that's true like over a lifetime. Like over a lifetime, you look back and your whole fortune is made by a handful of winners, even though you might have picked, 500 stocks in your life, which is really kind of weird. I mean, at least that's my experience so far. I'm almost 60 and that's the way it's been for me.
Yeah, that's been my experience too. I would say, each year there's that one stock or maybe it's two stocks that makes my year. And a lot of times you'll be in the same stock for 2 or 3 years. So it's going to make, 2 or 3 of your years. And it's those really big winners. And I think the mistake most people make is they cut their winners too soon and they kind of stay with their losers. And I run a very concentrated book. I'm 6 to 12 names, usually about 8 names on average. And so I'm playing 10% or bigger. And you have to have those winners and you have to just let them do what they're going to do. I own a tanker stock called Scorpio Tankers. It's my largest position. It's at 39 today. I bought it at 17 in January. I wrote about it in my blog a couple times actually because I was so passionate about it, much like I'm passionate about Altisource. And it's at 39 today, and I think it's going to go up quite a lot from here. I mean, there's a pretty good chance they earn more than 39 a share in cash flow this year. It's like it's not going to trade at one time if they do that.
Wow. Yeah. And it's $39 now, 39 in cash flow. That'd be nice. Wow. Make me want to run out and buy it. There's another position that you talked about on your website, and it's interesting to me because every now and then I talk to a guy like you who is a value investor who's got some macro ideas working, and you have some ideas about the dollar, which I think you said you stopped out of your short dollar position.
Yeah, I did.
Why do you think the dollar will fall in value?
Well, let's look at it at a few levels. At the starting level, anything that's good that's happened for the dollar in the past 3 years has happened. Whether it's repatriation of capital or it's fund flows, because every single human on this earth has to own Apple and Amazon. Whether it's faster growth rates, whether it's interest rate differentials across U.S. Treasuries versus Eurozone or Japan. I mean, I can give you a list of 20 of these things, but anything that's good has happened, and the dollar's gone nowhere. And I'm a trader, at first, and a fundamentalist in terms of investing and valuation second. And when the trade says all this good news is happening and you see no price action, then there's something wrong, because if good news doesn't move it, bad news definitely will. And so in a very, very big picture, I see that as being, a setup that doesn't seem attractive. Looking further ahead, I kind of see that a lot of other countries, Europe, which is, a huge contrarian play to be long the euro. I think they're closer to doing a fiscal stimulus than we are. They've taken monetary as far as it goes. We have over 100 basis points of room on the monetary side, which isn't dollar bullish. I just think you're going to see more things happen that are dollar bearish. And I know everyone has this view that the dollar goes up when you have a shortage of dollars and a financial crisis. But I mean, we just had the not QE, and it's kind of proven that if there's a shortage of dollars, they're going to fix that. And you have Trump sitting out there who doesn't want a strong dollar. And so I just don't think you have much upside in the dollar, and potentially you have a lot of downside in the dollar. And that's kind of how I look at it conceptually. Of course, it hasn't worked. It hasn't not worked, really. I mean, the euro's been in a 2-cent range for the better part of 9 months now. Canadian dollars in like a 2.5-cent range. Like it's kind of a nowhere, which also kind of gives you the impression that we're making a reversal, and it's a long, drawn out reversal. But usually when price action stops, it starts going the other way.
I see. And the position that you talked about was short DXY, the basket of currencies against the dollar. But do you view long gold as the equivalent of short dollar?
Yeah, absolutely. Long gold is the only currency that doesn't have a central banker. It's the obvious one you want to play. The problem with long gold is a bit more volatile, so you play it a little smaller. But no, I think long gold is obviously the way to play this, and I own some gold, and I think everyone should own some gold for that matter. But I think there's also some currencies like I think Canadian dollar is going to be just fine. I think Russian rubles are going to do phenomenal. I think there's some of these currencies out there that you can play, and I think you can play them in size and feel safe. But yeah, gold, obviously.
Yeah. Russian ruble sounds gutsy to me.
Look at the chart. It's been working. Of all the currency basket I put on, that's the one that did the best. Plus, it paid me the best carry.
I mean, yeah, I'm not a currency guy, so I just the words Russian ruble just scare the crap out of me. Is all I'm saying.
Yeah, no, I don't blame you, but that's why it's worked so well. Look, I'm not a currency guy either, but I travel a lot. My wife and I just got back from Portugal last week. We travel, I don't know, half dozen countries a year and try to spend a week or two in each of them. And I've done amazingly well in currencies over the years, not because I look at economic statistics, not because I look at charts. I really just go there and say, does this feel cheap? Is the hotel cheap? Is it cheap to get dinner at a nice restaurant? Is a beer or a bottle of wine cheap? And if you buy currencies of cheap countries, as long as they don't speak Spanish, you do really well. And the first rule of currency is never own the currency of a Spanish-speaking country. So as long as you avoid that one pitfall, you're going to do just fine.
And I just want to say, in this era of political correctness, that I love Spanish-speaking people and countries. Just don't like their currencies.
No, my wife's Mexican, so she always reminds me that in her lifetime, the currency has never had an up day. And she's pretty much accurate about that.
Wow. That's awesome. I mean, if you're on the right side of it, I guess it's awesome. Not if you're in Mexico.
Actually, it's not been bad for Mexico either. They always have a cheap currency, and they do a lot of trade with America. There's a structural reason for it.
I see. Yeah, well, that makes sense too. So you've been all over the world, it sounds like. 5-6 countries a year for what? How many years?
My whole life, I travel a lot. I find that you learn a lot when you travel. And I think the biggest mistake a lot of portfolio managers make is they feel like they have to be in front of their computer, quote unquote, if something happens. Look, last night, something almost happened. The market went crazy. If you had made a decision, you probably made the wrong decision because the situation's fluid and stuff's going to happen tomorrow and the next day until it's all sorted out with Iran. Like, why would you want to be in front of your computer? Like, I want to know that I own the right stocks, and I want to be away learning something and find that next stock. And I want to be, not feeling compelled emotionally to change my mind on something because of some piece of news. And the worst thing you could do is talk yourself out of a great stock just because, Trump tweeted something or Iran did something, or you heard something from some other guy that's commenting on something. You just have to be positioned and position it correctly. And there's not that much you need to do day to day in the market. And I think the guys who do the most often have the worst returns. And besides, travel is fun.
Boy, what you just said there is a huge point, especially for our listeners. And I know a lot of the readers of our Stansberry newsletters, they're just too active. They're way too active. And you made the point earlier when we talked about how there's just too many smarter people with a lot more information doing these short-term trades anyway, so you can't get an edge. And, sitting there in front of your computer trying to get these short-term trades to work is just, it's like financial suicide for the majority of individual investors. So,
Right.
yeah, travel, read, get away from your computer.
Learn,
Absolutely.
meet people. I don't know if I'm ever going to invest in Portugal, but I now have some friends there. If there's a good opportunity, I know who to call. I know what to do. And if they see something, they'll hopefully flag it. A lot of what I've done in my entire career is because people have reached out to me and said, hey, Cuppy, you should really look at this thing. I own a bunch and it's interesting. My biggest winner percent-wise this year, it's been a triple for me, is a company called Stage Stores. And I just had a friend reach out to me and he's like, hey, Cuppy, I was short this thing and I saw the press release, I covered and it went long. You should look at it. And then the stock's at 3.5 and today it's at 9. And the whole move happened in 6 weeks. It's almost a triple in 6
Wow.
weeks. Like you don't get a lot of those in your career. And I think it might go up a lot more.
You still holding?
Yeah. I'm actually meeting
Nice.
management next week at ICR, so I'll have a much better view on what's going to happen. But it's the people that lead you to the great opportunities. And I spend a lot more of my time just meeting interesting people and trying to learn industries.
So while you were talking, I brought up a chart of Stage Stores. The 52-week range is 55 cents to $9.25. Yikes. That's a move and a half.
As we said, earlier, you only need one or two of these every year, and you're gonna have a very good year. And I've had a good year on Stage Stores. But it kind of goes back to my strategy also of I'm not trying to find something at 10 that's going to 12. I'm looking for something that has dynamic upside and has inflection potential, and that can really do something interesting to the upside. So you need to be investing at an inflection or potential inflection.
All of this kind of makes me wonder, is there a process? Are you just looking, it sounds like to me like you're looking at all these small names kind of one at a time, bottom up, looking for just limited downside, inflection points. What is a stock? Is there a general rule that you can apply? Is there something you can tell us that says, yeah, stocks with XYZ traits, that tends to be an inflection pointer? Is there any kind of a general rule for this stuff? Because it sounds very one-off to me.
Well, there is a general rule. You start by looking at sectors that are inflecting. By that I mean, people talk about global macro, and I like to say I do global micro. Global macro is currencies and interest rates, and there's too many smart people there. I don't have any strong edge. But then you go drill down, 1-2 layer down, and we have what's called global micro. There's not a lot of smart guys looking at shipping, so I have edge there. And some of the other sectors I'm looking at, there's not a lot of guys there. And so you can watch it, you can see it inflect, you can see it start getting better, and you can jump on the train. And you want to jump on a train in motion. You don't want to be sitting there telling the market when you think it's going to bottom. The market will tell you. And so I have this huge list of sectors I'm tracking. They tend to be, commodity, cyclical, company specific. For instance, Altisource. You could look at this and say it's a software company, but I look at it and say it's default mortgage servicing. It's been a 10-year bear market where for 10 years in a row we've had less defaults than the year before. And then in Q1 this year, for the first time year over year, you had an increase in defaults. It's the first uptick that says let's start looking at this because a trend in motion is starting to go the other direction. I think Q4 will also be a year over year. So you have 2 out of 4 quarters showing year over year increases in something. So you're looking at a micro trend, which is defaults, mortgage defaults in the United States. And you're saying this trend is starting to reverse. Let's go figure out who benefits. And, you could look at this in lots of cases. You could also look at trends in motion that are already in motion that are strong trends, like, 5G, for instance. We know that it's going to be one of the biggest infrastructure cycles in the history of the world. You want to have exposure to a trend like that. You don't have to be all that smart to know that there's going to be a lot of money moving around. So you can have your, true micro, which is U.S. mortgages, or you can have your, very, very visible micro trend, which is 5G. But you need to be investing with the trend. You need to be finding companies that benefit from these trends. And that's the first step. Then you go and look for individual companies. And, it's kind of why I prefer Scorpio, say, to any other one of the tankers. There are specific reasons. In particular, they have more scrubbers than most people. And I also like product tankers, for instance, than dirty tankers. But you have to first find the trend, and you can't just go looking through cheap companies that scan on price to book or price to cash flow, because that's all backwards in looking information. And this supercomputers run by guys like what's it called Medallion and some of these other guys that really Rentec, they see this stuff, and their computers are smarter than I am, and they'll figure this stuff out. You're not going to have any edge there. Your only edge is looking forward, because computers don't see inflections. Computers don't have that sort of data to look forward yet. In 10 years they will, but they don't yet.
In 10 years they will? They will be able to look forward?
I think so. I don't know. I'll probably be obsolete at some point. But, when you think of a computer, okay, so much of the U.S. stock market's run by quants that have really detailed computer modeling. And they're really smart, these computers. But the computers are only as good as the data that's put in. So, for instance, take shipping. There's never been an IMO 2020 before. So the computer doesn't have that in its data set, so the computer doesn't see it coming. It's kind of why you see short interest keep building in a lot of these tanker stocks. The computer, looking at its backtest data over the last decade, says every time you have a short-term spike in charter rates, short the stock, it makes money. So, the computer's doing exactly what the computer's programmed to do, when the computer really should be buying the hell out of it right now, because there's a sea change with this IMO 2020. I think you can see that in lots of other, micro sectors where the computers just don't have the data yet, because it's the first one of whatever it is to happen.
Interesting. Very interesting to me. I too, I totally agree. All that price to book stuff that folks like, Tweety Brown and others used to do a long time ago. It's just, it's too easy to do on a computer. And now what I've taken to doing is I just don't screen anymore. I don't use stock screeners anymore, because like you say, all the data that's a fact is in the past. So they can't tell me anything about the future. So now what I do is I just go through the list, literally the list of public companies trading on NASDAQ and NYSE, and usually within a given market cap level where I think I can get some kind of an edge. I'm not going to have an edge on Apple, right? So
No.
And you look at them one at a time, and you look at industries one at a time, like you're saying. I at least that's where I am these days.
I agree completely.
And that's how I found a bunch of winners in the past.
The Tweety Brown model of cheap price to book, over time, you'll probably make good money. The problem is that if you don't have a catalyst, your money's sitting there waiting. You need to have a catalyst on everything you're doing. You need to have a secular, you have some sort of tailwind that says this cheap stock will not be cheap next year because XYZ is going to happen that inflects the business. It's all about finding potential inflections. Sometimes things don't inflect, but if you don't have your catalyst and your inflection, then what do you have really?
Waiting is what you have.
Yeah, exactly. Which is why a lot of these value guys earn respectable high single digit, low double digit returns. But you really want to be out there doing better than that.
Otherwise, why do it? That's right. Yeah, we're getting near the end of our time here, and I have this question that I ask everybody that I interview. And by the way, I just want to say thank you, too, for doing this, because I love your website, adventuresinCapitalism.com. I hope that our listeners will go there and check it out and learn more about you and your ideas, which I think are very good. But if I could ask you, Harris, just if there's one thought that you could leave our listener with, if I said, okay, you can leave our listener with one thought, you get one thought only, what might that be?
Well, that's a tough one. On the investing side?
You know something? The last guy asked me the same question. I said, anything. It can be about investing or not. One thought to leave our listener with on anything.
I would say leave what you're doing right now. Go book a flight somewhere that you've always wanted to go. Take your best friend, take your wife, and just go do it for 2 weeks. I literally had some great Portuguese food in Miami 3 days before Christmas. And the next morning, I booked a flight to Portugal because I said, let's do it. And I don't think enough people leave their little bubbles. And whether that's your echo chamber on Twitter or Facebook or your friend circle, and look at other people's perspectives, because everyone has a perspective and everyone's perspective needs to be listened to and appreciated. You might disagree with them, but if you don't know their perspective, how do you disagree with them? And so I would say just go out there and go do something interesting and go meet new people that think differently, and don't just tell them they're wrong. And you never know what you learn when you're doing something different, and you're never going to learn anything sitting in your own home.
Wow. That was awesome. Thank you for that. I hope people take you up on it. I want to take you up on it. I want to run downstairs with my wife and say, let's go to some other country we haven't been to
Just
right
do
now.
it. Just do it. I had
Yeah.
I'd say most of the vacations I've taken haven't been these long premeditated, oh, I'm going to go here. Like sometimes we'll have a wedding somewhere and we'll spend 2 weeks after. But I'd say the vast majority of the time, I'll just be sitting at my desk and I had a bad investment, or I'm fully invested and I have nothing to do. And I'll just ask my wife where she want to go. She hasn't been. And that night we'll leave. And, it's just great because you get to be in a different place and learn something new. And the best investments usually come, and in the end, we're in the investment business, come from meeting someone who changes your view about something.
I totally agree with you. None of my biggest winners came from, stock screen sitting in front of my computer. That's a great
No.
point. So ultimately, your one thought is about investing, among many other even more important things. And I thank you for it. All right, Harris, that's the end of our time. And again, thanks so much. Love your work, love your ideas, and I hope that we can get you back in here sometime. How about that?
Yeah,
That sound good?
absolutely. Happy to chat anytime. And, for readers, as you mentioned, Adventures in Capitalism is my blog. You can sign up for updates. I won't spam you. I write once or twice a week, or maybe no times the week if I'm traveling. And I write about stock picks and my views of the world. So, yeah, I appreciate you having me on. Thank you.
You bet. All right, we will talk to you again, hopefully sooner rather than later, and thanks very much. Bye-bye for now.
Yeah, bye-bye.
All right. That was a lot of fun. I love that guy. I love his ideas, and I know you probably love all the concrete stock ideas that you heard. But, if you go on his website, he'll tell you, don't just buy it because I mentioned it, kind of a thing. Do your homework, make sure you understand the situation, because I think some of his positions, they're more volatile than normal because they're smaller cap names than most of the stuff that we write about certainly in my letter, Extreme Value, or in a lot of Stansberry products. So, with that, yeah, really, really great conversation. And let's take a look and see what's in the mailbag. It's time for the mailbag. The mailbag is where you and I get to have a conversation every week. And that really, to me, this is almost like the heart of the show, because this is where you and I get to address each other like adults and ask frank questions and comment back and forth and have a real conversation. The purpose of this podcast is to make us all better investors. And I think we get some great stuff from people like Harris, and hopefully I find some good stuff in the news when I start out the show with my little rants and stuff. But, this is where you and I really kind of put the rubber on the road. So write into feedback at investorhour.com with any comments, questions, or politely worded criticisms. And I will read every single one, and I'll I'll read as many of them here on the air as I can and address your concerns. But write in, feedback at investorhour.com. Lately, the feedback has been good, and I really want you to keep it up. First one is by Eric H. And Eric H. says, Dan, you've shared lots of metrics of how the stock market is at all-time highs recently. One metric I've read about is the cyclically adjusted price earnings, CAPE, ratio that measures corporate earnings over a 10-year period. That ratio is also at all-time highs, which is concerning. However, one counter-argument is that up until now, the 10-year period in the CAPE includes one of the biggest recessions in history, thereby suppressing the earnings in the denominator of the ratio. Once the 2009 recession is outside of the 10-year window, Historical earnings will rise and the CAPE will naturally fall back to more normal levels. I'm curious to hear your thoughts on using CAPE to measure stock market valuations. On a somewhat related note, I've heard you say that you don't put much emphasis on a stock's PE ratio. As a value investor, how do you ignore this ratio? Aren't a company's earnings one of the most important factors when determining the value of a stock? It seems like a growth-oriented investor would be more inclined to ignore current earnings. Thank you for sharing your thoughts. I love the show and never miss an episode. Eric H. Thanks, Eric. 2 issues. CAPE is not a big deal. It's been 10 years already, and so we're back to like 2010 or something right now, and the big drawdown was in the fourth quarter of 2008 in S&P 500 earnings. So, we're really outside of that, and I think the recession continued into 2000. I think it was actually over in 2009. So we're beyond that now, and it's still really expensive. Besides that, CAPE isn't that great to me. I think John Hussman over at HussmanFunds.com has done this work, and he's better than CAPE, which is done by Robert Schiller, a guy at Harvard. And Hussman has found 5 measures that do a much better job historically and correlate much more negatively with subsequent performance of the S&P 500. So what that means is when you use Hussman's measurements, when they go way up, the stock market performs poorly for 10, 12 years after that, worse than in relation to CAPE. So CAPE isn't my favorite thing. I don't really pay much attention to it. I like what Hussman does better. As far as PE ratio, it's the E that I have a problem with, because E is GAAP earnings, and you usually have to do that. You usually have to do a fair amount of work to get at a better earnings number. And what we really want is after tax, after CapEx, cash flow, right? We want real cash earnings, excess cash earnings generated by the business. That's how you value a business, by the excess cash you can pull out of it during its life. That's why I ignore PE, because headline PE ratios have all kinds of noise in them that I don't care about. Good question, though. Dan, I was just wondering where your wife got the periodic jar from. It would be a great gift for my dad. Thanks, Kim M. Kim, she's talking about, I said my favorite Christmas present was this periodic table of elements that actually has little pieces of every element, all the gases, all the radioactive stuff, everything. And it's by a company called Engineered Labs Protoshop, LLC. I think you can just Google that and away you go. Next one is from Abid S. And Abid says, he's basically taking issue. I was talking about the assassination of this guy Soleimani, and Trump droned the guy and they killed him near the Baghdad airport. And he was a big terrorist guy or whatever. And I said, we shouldn't go around the world whacking hornets' nests because it'll come back to bite us. And that's, doing this stuff is why people are angry at us in the first place. And I said, these people believe in martyrdom. And Abid is writing in to kind of correct me and set me straight. He says there are 2 main branches of Islam, Sunni and Shia, sometimes pronounced Shiite. Being a Shia Muslim doesn't automatically classify that an individual as an extremist. It doesn't automatically classify that individual as an extremist. Okay, got it. It is a term used to categorize Muslims into 2 large subgroups based on their beliefs regarding a successor after Prophet Muhammad's death. As an example, Abid says, I'm a Shia Muslim and definitely am not an extremist and do not value martyrdom. So I just wanted to read that so that you know that I'm, this guy is setting me straight here. But I still think that the extreme folks represented by that Soleimani character, they do value it. They do now see him as a martyr. So I got the big picture wrong, but I think the small picture is right. The next one is from Mike S. He says, forgive me for this political, in quotes, comment. He says, it's an axiom that markets hate uncertainty. I can't think of anyone who contributes more to uncertainty than the current president. And then he goes on to explain, why he thinks that. He said, wouldn't it be better if someone like Biden got elected? He would be much more predictable and not unfriendly to Wall Street. Your thoughts, Mike S. Okay, Mike, I hear what you're saying, but my personal viewpoint is that it doesn't matter who gets elected. In fact, I'll go one step further. I think anybody who thinks that Donald Trump is so terribly different, better or worse, than Obama, and Obama's so different than the other guy, Bush, and Bush, then Clinton, and Clinton, then, the other Bush, Reagan, Carter, Ford, all the rest of them, all the way back. If you think one of these people is very different from another, I think that's a mistake, and I don't think it matters. That's my personal viewpoint. It took me a while to sort of figure this out, if I'm right at all, but that's what I think. So no, I don't think it would be great if Biden got elected. I don't think it would be great if Trump gets elected or great if Biden. I don't think it matters. Thomas Y. writes in and he says, on the great gob of money that was pulled out of equity mutual funds and ETFs last year, is it possible that what's actually happening is a steady stream of baby boomers like me are rolling past the magic 59.5-year mark and withdrawing funds from the limited ETF choices in their 401ks and retargeting these funds directly into the market, like me? Well, Thomas Y., yeah, I think that's possible. I don't know what exactly they're doing, but I just know that it seems like a lot of folks are not, the participation among individuals isn't as heavy as I would have thought. Last one, folks. This is from a guy named S. That's his name, S. And he says, hi, Dan Ferris. And he's talking about my comments about Soleimani and that we shouldn't go around the world whacking hornets' nests. And he said, I would like to know your solution to stop all these bully terrorist leaders we have in the world and not hurt their feelings, as you suggest. I never suggested anything about hurting their feelings. So you're misrepresenting me right away. Then he continues, doesn't the problem with most of these terrorist-run countries that the people living in these countries don't do anything to stand for these bullying tactics that started years ago? Should have done something then. Anyway, it continues in the same vein. And the idea is that I'm wrong about this because, these people are terrorists and they're bullies and we need to take them out. Well, you and I genuinely have a chicken egg problem here, don't we? Because it's probably difficult to pinpoint the moment at which I could say, see, we're running around the world doing bad stuff and these people hate us for it. And it's probably difficult for you to pinpoint the moment when you could say, see, they're doing bad things to us, so we have to go kill them. Frankly, one thing I do know is that the Middle East is halfway around the world. And the founders of our country were pretty clear that they thought, maybe we ought to go around getting ourselves involved in other people's business and other people's wars and other people's problems. And I think this idea that we do need to go around the world getting involved in other people's business is a mistake. I'll just leave it at that because I don't want to get into it. I don't want to get all political. I'm just saying that we kill this guy and then maybe he does something to us and maybe, it's like, even if it's half as bad as 9/11, we don't want that, right? That would be a big, fat, hairy, ugly surprise, and people would die, and it would just be bad in a number of ways, including, of course, the stock market would hate it. But so that's part of the point, is that you're setting yourself up later. That's what I don't like. I'm not saying you don't have a point. I'm not saying they're good people. They're not good people. Right? They think that, murdering a certain type of person, going out and murdering whatever they call us, infidels or something, is good. Well, I don't think it's good, and I think it's objectively wrong to do that. But, the United States runs around the world doing this kind of stuff too. So people think we're terrorists. Some people think we're the terrorists. And whether or not that's right or wrong, I don't care. I just want to know the state of things. I'm not pronouncing moral. I'm not picking sides. Isn't that the way today? Everybody's picking sides. Are you liberal or are you conservative? Are you Republican or are you Democrat? And that's just not the way life really truly works. And when you try to shove the beautiful round peg of life into the square hole of picking sides, you screw up and you create problems. That's my point. Okay, That's it. That's another episode of the Stansberry Investor Hour. It's my privilege to come to you this week and every week. And by all means, whatever you have to say, write into feedback@investorhour.com and say it. And go to that same website, investorhour.com, and you can see a transcript of every show we've ever done. And you can listen to every show we've ever done. And you can put your email in and get an update, an email that tells you about every show we're ever going to do. Everything all in one place. Very nice. But what you really want to do is go to the iTunes store. Subscribe to the program, subscribe to Stansberry Investor Hour, and give us a like. This will make the show better. More people will listen. It'll bump us up in the rankings, and we'll get lots more cool feedback, like all the stuff that I read today. That was a lot of feedback. I love it. Keep it coming. Okay? So that's it for this week. Thanks so much. I will talk to you next time. Bye-bye for now.
Thank you for listening to the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email at feedback@investorhour.com. This broadcast is provided for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.